Adam Taggart, welcome back, my friend.
Such a pleasure to be here, Todd. Been too long.
It's been a while, you've been traveling, you've been at some conference, and I'm just kind of curious. You went to the Rick Rule conference in Boca, and I'm just kind of wondering, why did you ask him why he has it in Boca Raton in the middle of the summertime when it was probably like 150 degrees?
It was. Well, I didn't ask him directly, but I think he outed the answer to me in a recent conversation where he said he'd asked the hotel, "What's your lowest demand week of the year?" And that's when I want to have my conference because that's when I'm going to get the best rate. So that's just Rick being a good businessman.
Right. And I figured that as much. I saw a lot of the comments like, why would he do that? And I'm going, well, it's got to be the cheapest time to have it in Boca. Anyway, Adam, you have a YouTube channel, you Thoughtful Money. Obviously, you're doing very well educating people on their financial well-being and whether they're doing well or not. Maybe you've been giving them a bunch of advice on how to do well. And I want to cover a lot with you today because we're kind of all just sitting around scratching our heads saying, what the hell is going on? I mean, the stock market is outrageous. At least it appears that way. Gains, every day seems to be gaining more and more. The numbers are going up.
Mm-hmm.
What's going on? I mean, what did you find out at this conference, and what is your takeaway with what we're seeing with the economy saying one thing and the stock market saying something else?
Yeah. As I like to tell people, if you're not feeling confused, that probably means you're not paying attention right now. There's so many different cross currents. And it is a really interesting time where, like you, Todd, and we're very much kindred spirits. So it's always so fun to come on your program here. It's a time when very smart people can look at the same data and come to just wildly different conclusions. And I know that can be really frustrating for the average person who's just trying to make sense of all this. When even the smart people, or the supposedly smart people, don't seem to see eye to eye. And like you, I interview a lot of people. I probably do more interviews than you, Todd. You probably beat me out on quality, but quantity, I think I've got you beat. I do about 5 a week or so. So I'm out there every day, talking to folks on this. And, what I'm increasingly hearing sort of from the synthesis of all those people that I talk to is, or at least what I've taken away from all those conversations is I think there are reasons to be concerned in the near term about more disruption, more market volatility. And a lot of people think, oh, phew, we had that big market drop in April, but that's ancient news now, and now we're back to the races and everything should be fine. I don't think that volatility is over. And I think we are entering an era where that disruption and that volatility is going to create some real winners and losers, I think, on a much more permanent basis than we've seen in a good while. And I'm happy to kind of peel back the onion on each of those things. From an economic standpoint, I think that right now we have interest rates, bond yields that have remained higher. That they went higher than most people thought they were going to be able to, and they remain there for a lot longer than folks thought they were going to be able to. And that's the higher that interest rates go, the higher that bond yields go. That's just like gravity on the economy. And so the longer we hang out there, it's like just the more gravity has a chance to try to pull economic activity downwards. And we're seeing lots of signs that the economy is slowing. It's not just the interest rates on corporate debt out there. We're seeing it sort of everywhere, right? So everyone who's been paying attention to the headlines knows that interest service payment as a percent of the deficit has, of our deficit has or our budget has dramatically increased over the past couple of years, now exceeds what we're spending on national defense, or it did. I guess we just bumped up defense, but it's going to be pretty close again to being larger than defense. We're certainly seeing it in corporate America as more and more companies that loaded up on cheap debt prior to the Fed starting to raise interest rates. That debt is increasingly coming up for renewal, and so that means that companies have to refinance their debt. It's now going to be at a much higher rate, and so there's just that eats into profits, right? There's just less left over for reinvestment into the company or paying out as profits. We're seeing the same thing happen at the household level, right? Where mortgages are 7% still, right? And so that basically has kind of strangled the ability of aspirational home buyers to be able to afford a house. And we're seeing that on just all sorts of consumer debt, right? Like 20% APR credit cards, right? So, all of this higher for longer debt just acts as additional weight pulling the economy downward, right? So I think I can go a lot deeper into that, but I think just to kind of give you my long-term view is, I think in the short term, we're going to see that continue to slow the economy. We're going to see repercussions of that. I think that's then going to reflect in the markets, where the markets are going to have to reprice, because right now they're priced for perfection, maybe even some cases, Todd, better than perfection. So that's going to have to reprice. That'll return that market volatility that I talked about. So I could see it being kind of rough, at some point over the next 6 to 9 months or so, as those things really begin to manifest.
Hey guys, I hope you're enjoying the show so far. I just wanted to take a brief minute and share some exciting news. I have just released my new Todd Simple home buying course. This course is designed for anyone wanting to know how to buy a home. It's 14 lessons, includes worksheets and resource guides. It's designed to take you through the entire home buying process from start to finish. You'll learn how to represent yourself should you want to avoid paying real estate commissions, the best ways to shop for a home, how to avoid costly mistakes, what to look for when touring a home, negotiation tactics, and so much more. If you've followed me here on YouTube, you know that I am very transparent in my videos. In this home buying course, I hold nothing back. In fact, I would go to say that no one has uncovered the home buying process like I have. I'd even recommend this course to most real estate agents, as they will probably learn more about the home buying process than any other training that they've received. I've even made a way for you to gift this course to your family and friends. Visit sacsrealty.education. The link is also pinned in the comments below. And for a limited time, I'm offering a 10% discount on Todd's Simple Home Buying course. Just enter the coupon code Todd when checking out. Now back to the show.
At some point, we're going to see, hopefully, the cavalry ride to the rescue, as these business-friendly policies that the Trump administration has been pushing through, those are going to start to bear fruit. And we're going to start to see increased CapEx coming as part of that. We're going to see some of the benefits of these trade deals, hopefully. We're going to see the benefits of the deregulation. So I actually am kind of fairly optimistic, kind of in the midterm. I mean, there's definitely still some risk of that materializing, but I think there are good reasons to start being optimistic. I'm personally more optimistic midterm than I've been in a good while. But then I think in the long term, we are headed towards a system where the benefits of a lot of that, that golden age, if it indeed does materialize, I think are going to accrue to a smaller and smaller number of players, especially as AI really begins to make itself felt. And so we may see an era where overall the economy grows, corporate profits grow, but they're increasingly concentrated in a smaller number of the really big players that can afford to really deploy AI at scale. And so it's not going to be sort of widespread across the general economy, and it's going to increasingly be at the cost of labor. And so I do, and I've been very vocal about this, I do have a hard time as seeing this AI revolution as anything but a massive jobs killer at scale. And while that might be good for the big hyperscalers in our economy, it could be very, very bad for the wide masses of rank and file employees. So we can talk about that, but I kind of wrap all this up by saying, Todd, we have increasingly been been on the trajectory of having a K-shaped economy. And I think you and I have talked about that in the past. I think most viewers know what I mean, where the smaller upper half of the K has been doing increasingly well, while the larger bottom half of the K has been struggling. I see us moving fully towards an I-shaped economy. And by I-shaped, think of like the letter I, where it's a little dot. It's a little small group of elites that are prospering and protected at the very top. And then everybody else below them is increasingly struggling. I fear that that's where we're headed over the long run. But I think the way we get there, like I said, is maybe some short-term, turbulence, maybe, some midterm, sense of, hey, we made it through and things are getting better. But then we realize, well, wait a minute, actually all these benefits are going to very few people at the top. And increasingly the rest of us are getting left out of the party.
I want to just go back to where you said that, first of all, and I want to say that, sort of like from a nonpartisan standpoint, I know, Adam, people hang on to every word that we say, and it's hard to not offend somebody when we're talking about policy and change and administration, and pretty divided, right? It seems like anymore you can't have conversations with someone who doesn't agree with what you're saying or even suggesting. They want to just fight. And the way they do that on your channel, my channel, is they let us have it in the comments section. But I want to kind of just go over. I think that everything sounds promising in a theory that we're going to do better one day. I'm hopeful, right? I think the disconnect is, and whether you agree with the Trump administration or not, we didn't just get here in 4 years or 8 years or 12 years. I mean, this is where we are with the haves and the have-nots has really been a process of decades of manipulation and very smart people figuring out a way to do really well financially. Not that they were necessarily meaning to make peasants out of the rest, but certainly we have seen how difficult it is, especially lately, for young people to make it and live and benefit like some of our predecessors. Our silent generation maybe saw the depression, but results of the depression. But baby boomers have done well. Gen X has done well. But where do you share, and I'm certainly not trying to be antagonistic at all, but I'm just kind of curious, what is the hope or the fruit that you talk about that you think that we're going to see with some of these decisions that are being made by Trump?
So, and I'm not the right, I'm not I'm like you, Todd, where I really try to take things from as independent a perspective as possible. I think it is fair to, there's going to be detractors and doubters on both sides. So again, folks, feel free to disagree with my opinion here. But that from an economic standpoint, I think it is fair to say that the playbook that Trump is following, which borrows heavily from the Reagan playbook, has a more demonstrated history of resulting in nearer term a higher economic growth, right? And of course, the playbook there is hey, if we just sort of let the government get out of the way and everybody gets to keep a greater percentage of their profits, and there's a higher profit motive here, and there's less regulation getting in the way, we're going to grow the pie, and everybody's going to benefit more on average. And to be honest, I mean, I think if you compare that to a lot of the other playbooks from a lot of other administrations since the Reagan era, there's I think a pretty good argument to be made for that. We probably did have too much regulation. We probably did let too much concentration happened and the emergence of cartels, the government probably did get too involved in a lot of industries and making them less efficient and driving up costs. We could have listed that as long, healthcare, education, whatever. We can just keep going through it. So I think it is, I think the argument the administration is making that, hey, if the output of all this stuff that we're putting in place should result in higher economic growth than otherwise. I think that's a fair argument. Will it materialize? Who knows, Todd, right? We're still in the middle of, the whole tariff thing, and will tariffs be inflationary or not? Are we actually going to get better trade deals with our partners and grow our overall trade, or are we, angering the rest of the world and, driving everybody into China's arms and, all that stuff? I actually think that Trump has been a lot more successful to date than most people expected he would be. Again, this is not a partisan comment. I think that trend will probably continue until we have evidence that it doesn't. So, I would say this. I would say discount that at your, if your blanket assumption here is he's just screwing everything up, he's a bull in a china shop, breaking everything, and the economy is going to be, worse as a result. That might happen. But I think looking at the data that we've now increasingly seen over the past 6 months, I think things tend to increasingly be going his way in terms of where he's wanted them to go. And so if your default assumption is he's going to screw this up, you should at least have a plan B in place in case your primary hypothesis is wrong, right? But so I think the spirit of your question here, Todd, is, we will hopefully see, corporate profits, continue to sustain and maybe rise from here, even though they are at all-time highs. But who knows? This AI revolution may actually bring us to a new higher level of corporate profitability than we had before. That in theory should benefit the workers of those companies. They should want to hire. There is going to be, I think, a real boom in hiring for the trades as we do a lot of the infrastructure build out that this administration is prioritizing, both in AI with, zillions of data centers, but certainly in the energy and the natural resources space. So, it's not all doom and gloom here, especially not in the near to midterm. As I think, right now, there are literally millions of trades jobs that are unfilled right now that we need people for. We literally cannot find enough skilled tradesmen right now. So, I think that there is a decent story to be told here. Now, there are all sorts of questions that get raised about, all right, but what happens with the debt and the deficits, in the long run? The one big beautiful bill didn't go nearly as far enough as a lot of people would have liked it to see to get deficit spending under control. As you and I have talked about, Todd, that's really the meta risk here, which is that we keep spending beyond our means. The debts continue to balloon out of control, and the only way to deal with that in the long run is to devalue the cost of the currency, making everything basically much less affordable for the average person as the value of their money gets frittered away, and we end up in this two-tier class system that I'm talking about, this sort of I-shaped economy, where those at the top who own all the assets and the means of production get all the benefit, and everybody who can't keep up falls below.
Yeah. Well, I mean, and again, I'm just, I asked the question of what will the upsides be, because I'm hopeful that, we do grow our way out of this mess. I think, though, when I look at my industry, the housing industry, I just see that affordability is going further
south,
down, and the gap between a median cost home and a median salary in America is getting farther and farther away by the year, by the month, by the day, it seems like. And I don't know what the answer to that is. AI scares the hell out of me in a lot of ways because I see it as a major job disruptor, like you had said. One of the reasons why we're deregulating is that we can build these massive data centers as fast as we can. So that Trump wants us to be the leader of this technology in the world. I get that. But at the same point in time, that's one of the reasons why they're deregulating. because in order to get these data centers, they have to deregulate.
Yeah. And so, sorry to interject, but it's kind of like a gun to the head thing for us, right? Where winning the race for supremacy in AI, it's not just a lofty goal. It's like a national security priority or essentiality. Meaning, rightly or wrongly, but I understand the logic. The administration has said, "Hey, look, whoever wins the AI race is going to be the superpower of tomorrow, and we don't want to concede that." And I don't think Americans would want to concede that, but we definitely don't want to concede that, especially to potentially a player like China, who's the natural competitor in this race. And so we got to win it. It's kind of like the Cold War. It's kind of like the space race, right? It's like we just got to do whatever it takes to win this, right? And the benefit of that is continued supremacy on the world stage. But the cost of that, right, may be what AI does to our economy and society, right? And some of the risks that we've talked about here is it can just make potentially a huge part of society kind of irrelevant, economically speaking. And that has economic and just, cultural massive implications.
Well, I'm seeing it being used more and more in our industry. And you know what they say? I mean, look, you can listen to a podcast that's completely AI generated. You don't even need to listen to Adam Taggart or Todd Sachs anymore.
Yeah,
Now,
it'll be
I mean,
our AI avatars pretty soon. Yeah.
you're missing the human experience side of that, but it's kind of crazy. What did you learn? What was your biggest takeaway in this Rick Roll conference?
So the Rick Roll conference, it was very concentrated and focused. Rick's a natural resources investor, and it's a great conference, by the way. If anybody is willing to go to Boca Raton in July, if you're willing to run from air conditioning to air conditioning, it's a fantastic learning experience. And those who know Rick know that he is one of the most successful living natural resources investors. He knows everybody in the industry. So the value proposition of this particular conference is like when you go to a normal one in this space, it's kind of all the vendors and the speakers are the people who are kind of paying to be there, right? This one, Rick is the filter. He's just like, I'm getting, there's a lot of chaff in this industry. I'm just making this wheat only because I know all the players, because I know all the companies, I know all the speakers. I'm just bringing in the best of the best. So it really is nice from that standpoint. So, I would say a lot of it is just hearing about the opportunities in the natural resources space, of which I think there are a lot right now. I think cyclically, this is a really good time to be a natural resource investor. And if any of your listeners have been invested in gold, silver, uranium, et cetera, over the past year or two, they understand that this is finally back into a bullish upcycle after a long time in the wilderness. And there's still potentially an awful lot of room to run here. One, just sort of technically and cyclically, if you look at the ratio of the S&P 500 to the commodity complex, we're still kind of plumbing historic lows, like decadal lows. So that's going to revert to the mean in some way, shape, or form going forward. But also, as I mentioned, with this particular administration, we've got such a difference from the previous one in terms of prioritizing drill baby drill, mine baby mine. So much of the build out here that's going to happen, all that's going to need natural resources. We've also decided we're going to rely less on the rest of the world for the natural resources we used to get from them. So rare earths from China is a great example of that. So it's just a very good time to be, or prospects look very good for this space going forward. And of course, the benefit of going to the conferences is you're hearing from all the individual companies that Rick really likes, and you can talk to their CEOs in the hallways and kind of get all the inside skinny on what's going on there. I'd say at a high level, beyond just that, a lot of the macro speakers there were, echoing a lot of the same things that you and I talk about, Todd, just more eloquently than I say them, in terms of how, at the end of the day, it's our national profligacy that's going to get us, and it's not just the U.S. with this problem; it's everybody else, all other countries too, pretty much. So, just the confidence that in the long run, the purchasing power of fiat currencies is going to trend towards zero, and what are the ways in which we as awake and aware investors can put ourselves in front of that, to at least not get steamrolled by it, and hopefully in certain cases prosper. But what's interesting is, like, I had a great opportunity at the conference to go, like, on a cocktail cruise with the speakers, and I got to sit next to David Stockman and another fellow there, uh, and who had, both grown up, like, they started their careers in the '70s, and they both had crossed paths with some of the greats. So one of the fellows there, one of his advisors was Hyman Minsky. David Stockman, was the youngest cabinet member of the 20th century. We worked under Reagan, so he had stories about Reagan, about Paul Volcker, about these greats of economics and the big decisions that they were making back then. And just so great to hear those stories from guys that actually were there in the halls of power when these decisions were made. But I mean, you will be hard pressed to find a guy uh, more pessimistic about where our debt and deficit journey is going to take us from here. And this is a guy, Todd, that worked inside the system, uh, ran the Office for Management and Budget, was an actual U.S. representative. So he served in Congress, served under the Reagan era, interacted with key central bankers like Volcker, then went on to form, he's one of the early founders of Blackstone. So he's worked in DC, he's worked on Wall Street, he knows how the system runs, and he basically can't come to another alternative in the long run that this kind of all ends in tears. And I don't mean to be so dark and so gloom and doomy about this, but it does give those of us who have a lot of the same long-term concerns that you and I have, Todd, a lot of validation. Now, what is interesting, and I'll just note this in contrast, Trump is running largely a playbook based off of the Reagan era. There's another fellow who worked at the Office for Management and Budget, actually before Stockman even did, and that's the economist Art Laffer. And I've interviewed Art Laffer, in fact, just quite recently, just about the week before I talked to Stockman. And Laffer could not be more optimistic about our future prospects. The whole golden age of America, he thinks that is totally lying ahead of us, and it's going to be here faster than we expect. And so this is where I get to what we were talking about at the very beginning, which is, if you're confused, I understand, because sometimes you can just get really frustrated by very smart people looking at the same data and coming to wildly different conclusions. Now, what I will say there is, I think Art is maybe a little bit more short-term oriented in his comments there than Stockman. Like I said, even I think in the midterm here, we're going to see some nice boost to economic growth coming from all the policy changes that have been put in place recently. I don't, and Stockman is looking out further, saying, yeah, but at the end of the day, the debts are uncontrollable, especially when you add all the unfunded entitlement programs into there. And Congress is never going to contain its fiscal spending largesse. And I think Laffer probably would maybe agree with that in the long term. I haven't pushed him on it, but in the short term, like I said, he's real optimistic, where Stockman is not optimistic about Trump's policies. Stockman puts it in the Trump screw and things up, Cam.
Well, yeah, and Art Laffer, I mean, he created the Laffer curve that he's so famous for doing, and basically showing that, and with Trump cutting taxes, Art Laffer believes that if you cut taxes, that there will be a certain benefit to make more money.
You provide more incentive for people to work more. Yeah,
correct. You to be more successful, and I get that. When you're talking about gold and precious metals, you would have to be more of a pessimist to the outcome of where we're headed, to think that we're just not going to go into some hyperinflation environment, which, I mean, it does concern me, because the pressure that's on Powell to whether he gets let go or replaced or buckles or see some phenomenon happen where, we're in such a great position now we can start backing off and dropping rates again. To me, that's insanity. I think rates should be raised, not lowered. I think we need some kind of recessionary or deflation in order to get this thing sort of back on track. I'm not so optimistic that we will grow this economy so fast that will be the answer to dealing with adding more debt to the deficit in hopes that we're going to inflate our way out, grow our way out of this. And I see the AI revolution as something that is going to make these jobs. Yeah, it's going to create jobs. You can't just create blue collar workers. I think it was, who was it? I forget his name. It on the tip of my tongue, but I was speaking at Bloomberg and Gunlock. And he said that I think it was him, maybe it was the chairman of BlackRock. Somebody said that we're going to be like 500,000 people or electricians short of building these data centers alone. Well, you said consolidation. What will happen is the big companies will end up doing all the work and gobbling up the smaller companies. That doesn't necessarily mean that it turns to more income per worker. Just means it's the only place to get a job. But when you're looking at these kind of data centers, I mean, who would be qualified to take on a project or a contract of that sort without working for a massive company?
Right.
But you're not just going to convince people to work hard for a living and do laborious tasks.
Gosh, so much to respond to in that.
And I'm trying to be, I'm not trying to be a pessimist here. I'm just trying to process this and say, how are we growing this out?
Right. Treasury Secretary Bessent, who is kind of leading the charge more or less on sort of explaining the economic policy, and I think does a good job. I actually really like.
He's a smart guy.
I really respect his talent. He basically is saying, look, what really matters here, and I think this is true in the near term. It's not, doesn't fix things in the long term, but he says in the near term, what we're focused on is getting. He's got his 3-3-3 plan, and part of that is getting the deficit down to 3% of GDP. If I've got that. If I've got that metric correct, yeah. So currently it's at, I don't know, 7-ish or something like that. But he wants to get it down to 3% of GDP. And if he can, he said that actually solves a lot of our problem. It takes a lot of the pressure off of it. Let's put it that way, right? And you can get that down to 3% one of two ways. You can either grow the economy or you can cut fiscal spending. And they basically already said, well, we're not cutting fiscal spending materially anytime soon. So it's all going to come from growth. So that's why they're leaning so hard into, all the reforms that they're doing and the renewed trade deals and, potential tariff revenue that comes in with that and all sorts of things. And I think if they're successful in that, and I think they very well may be to a fair degree, then we may feel some lessened pressure, in the near term, provided that nothing terrible happens. And of course, Todd, you and I know at some point in time, something unwanted is going to happen. We may have a natural garden variety recession, right? We might have something more than that, right? At some point, we always will. We always do. We always will. And then the question is, well, what's going to happen to the deficit as a percent of GDP then, right? And it'll probably slingshot right back to where it was, depending upon the new playbook and how bad that situation is and who's in power at the time. It could be way worse, right? Now that we've let the genie out of the bottle and we've started, adding fiscal stimulus in conjunction with monetary stimulus during an economic rescue, who's to say that we just don't cut everybody even bigger checks next time, right? So, like I said, I can believe them in the relatively near term that, like, yeah, a lot of the things you're doing will probably goose this economy for some period of time, and that will be better it'll feel better to more people than falling into a recession, right? So you'll probably get some nice kudos for that. And do I want the economy to grow? Yes, I do. But I think the way in which it's being pursued is not it's not a cure-all, and it doesn't solve the underlying issues, which is at the end of the day, as we talked about, the deficit spending and the debt. And that to me is just a ticking time bomb ready to get re-exploded the next time that we have some sort of economic development that we catches us by surprise or that we just can't work our way out of. Now, it's interesting. You mentioned a comment that I've heard many times over the years, and I've actually said it myself many times over the years, where you said, "Hey, maybe we need some deflation here. Like maybe we need a recession, right? A cleansing of the system." And I can definitely make the argument that while extremely painful, and I don't want to minimize the vast amount of collateral damage that would happen during that time, that would be a good thing long term. Right. To borrow another term from David Stockman, he talks about this period of increasing central planner intervention that we entered into, starting in the age of Greenspan, as the Great Deformation. And I think it's a great word for it. We have deformed natural market forces. We've stepped in to try to prevent them from happening and to try to engineer a different outcome than what reality wanted to have happen. And as a result, you break price discovery, you deform prices, you create this system that increasingly has to be propped up or rescued, or otherwise the natural forces want to create that clearing event and get back to a sustainable baseline. The problem is the more you deform it, the further away you get from that baseline. And if you were to correct to it, it's going to be an ever greater correction the further above it you get. So right now, like nobody in power wants to have their name associated of having been in power when that big corrective event happened. Now, does that mean that we couldn't still have a recession that relieves some of the pain but doesn't fix everything? Absolutely. I think that's probably what we're more likely to get here. I don't know if we're necessarily going to get a recession. I used to think a year or two ago probability was higher. Now I'm a little bit less confident about it, but I can see us having increasingly anemic growth and it feeling like a recession for more and more people until we start seeing some of the benefits from these policies. Like I mentioned, that's kind of a midterm type of thing. And of course, if those don't show, then it's a different ballgame. So I agree with you there, Todd, but I just don't want to sugarcoat it. If we were to just literally have somebody in office to say, you know what, this has gotten way too distorted, let's just let it clear out, that would be a near nuclear event for far too many households than I think any politician would want to stomach. Now, that being said, and not trying to sound callous, the dust would settle, the sun would still come up the next day. There would be a lot of people who had lost their jobs or had seen their portfolios get very damaged or whatever, but life would continue. And we could say, hey, you know what? We're now at a much more rational baseline where you can invest your money and not have to worry about a dramatic market pullback because the market's trying desperately to correct down to where it should be. We've cleared a lot of the bad debts. I mean, during big resets, a lot of bad debt just gets written off, right? So that could be a really healing process. It just being realistic about it as much as sort of rationally, I think we should do it. It would be so catastrophically painful. I just don't see anybody running the system being willing to let that happen.
Well, you talk about expecting anemic growth. That's not growing our way out of this debt. I mean, if you can't have, stagflation and dump a lot more debt onto the deficit and expect that, or debt that turns into more deficit, right? There's debt that is constructive, that you utilize that debt and you make money. So you're using the debt to do well. There's something else. If we have an anemic growth or stagflation and you dump that debt that turns into deficit, that's even more catastrophic. But I want to go back to your comment and get your thoughts on, obviously, we need growth in GDP. Right. I mean, we need to keep
that's every politician's goal. Yeah.
We need to keep consumers spending money.
Yeah. We're still a 70% consumer spending driven economy. Yeah.
Right. My question is, with housing and related services, got to get that in there. I'm a
Yeah.
real estate broker, but with housing related services, I've had very smart economists say, look, this makes up about 35% of our GDP. So when we add it all together, how are we growing our way out of this housing crisis that seems to be the Band-Aid? It sounds gross, but the sore is outgrowing the Band-Aid
The
that is
gangrene is
covering.
spreading faster than, yeah.
Right. What did anybody at this conference have any thoughts on the housing market, 35% of GDP, how we're going to grow that now that everybody is priced out?
Yeah, the conference didn't talk so much about it, but look, I mean, if you, again, listen to the administration, they're going to say, look, we're going to grow the economy, and therefore people's wages are going to go up, and therefore the delta between um, local incomes to home prices is going to start to shrink, and houses are going to become more affordable for people, right?
When has that ever happened?
Well, I mean, it does happen. I mean, some of these things go cyclically, but for it to happen, either wages need to go up and or home prices need to come down. Sometimes it's one-sided, sometimes it's a mixture of both. I personally think here that it is going to be much more home prices coming down than it is going to be wages going up, at least in the near term, to get the housing market sort of unstuck. And Todd, I've been saying, I think on your program for a long time, but I've certainly been saying on Twitter or X for past 2+ years, I've been sort of borrowing from the Game of Thrones and typing in "supply is coming." We had this narrative that you and I have, I think, debunked in the past of chronic housing inventory shortage. There's too few houses for home prices to come down, right? And I think there's a whole bunch of reasons to expect that inventory would start coming on this market as the market started to struggle. We've definitely seen that in more and more markets. So over time, I've changed that from supply is coming to supply is here to lower prices are coming. And now it's increasingly lower prices are here. So if you don't mind, let me just read you a couple of stats here. So housing inventory is now bounced back to pre-pandemic levels. So we are pretty close now to where listings were in June 2019. So before everything got really distorted and went bonkers during COVID, the inventory has been normalizing. I'm going to predict it's not just going to normalize to where it was right before COVID. I believe it's going to continue rising from here for a whole bunch of reasons. This is from Lance Lambert. Amongst the 300 largest metro area housing markets, 110 of them are now seeing falling home prices on a year-over-year basis. So that's pretty big. We went from basically not seeing any for the past bunch of years, and everybody's saying, see, they can't go down. There's too few inventory. Now a third of them, more than a third of them, are down year over year. And really importantly, Todd, that's up from just 31 in January. So, that's tripled, more than tripled in just the past 5 months.
Before you go into your next point,
yeah,
you said that I want to kind of push you to talk about why you think inventory is going to rise. You said that I won't talk about. You think it's going to rise even more, and you said you wouldn't talk about it. But
yeah,
tell us why. Tell us why.
Sure. So first, housing market's been frozen, right? So transactions have been at a standstill. I think as prices start, supply comes online, prices start coming down, you start unlocking a lot of people that were not transacting before. So that's just going to bring more inventory online. All the people that were trying to hold fast, right? I mean, there was a saying, right? Survive until 25 because they thought that mortgage rates were going to have come down by then, and they hadn't. But it doesn't mean that all the reasons why you got to transact haven't been going on in life: divorce, death, that type of stuff, right? Job loss, job transition. We have so many. What had happened in a lot of the more popular states where prices got the furthest out of whack is, understandably, that's where all the developers went, right? Hey, that's where we can move product, right? So those developers have pipelines, right? And so, we know that there's still a pretty thick pipeline of projects that needed to get done, and a half-built building has no value for a developer. So we knew that additional new inventory was going to be coming online in these markets, even as prices started to soften. We've been seeing that. We had investors, right, participate in a lot of these markets to a much higher percentage than they had in previous housing market cycles. Now, these investors, both on the mom and pop side and on the larger, more institutional side, remember, these homes are not the roof over your head, right? So it's an Excel decision for you. We're buying this because we think it's going to put capital, money in our pocket over time. Well, if the math starts turning in the reverse, where it's taking money out of your pocket, it's just another Excel decision. Well, get rid of it, right? So you have both, on the mom and pop investor side, you have that happening generally, but then you had this craze of short-term rentals, Airbnbs, where, during COVID, that was the thing to do, right? Was to, take a little bit of money, maybe some of the money the government was giving you, and use it to buy an Airbnb. And there were all these courses online about, how you were going to become a passive millionaire. And we saw an explosion of purchasing of units that then were converted into Airbnbs by new landlords. These were people that had not been landlords before. I think something like 50% of all Airbnb units hit the market after 2022, right? So you still have a bunch of people there who are now finding themselves both underwater price-wise, but more importantly, cash flow bleeding month after month, who are saying, I got to get out of this stuff. So that's a whole bunch of inventory coming on. With the larger institutions, it can be even worse. Some of these guys are deep-pocketed and can hold for the long haul. But a lot of them, or not a lot of them, but a growing number of them, as they get more and more distressed, say, you know what, I got to get out of this. And they might have bought 1,000 units in the same MSA. Right? So all of a sudden you have a market that doesn't have just one or two new homes come on, but might have dozens or hundreds, right? And as you know, housing's priced at the margin. You flood a market, the marginal price goes down pretty darn quickly. And what's interesting on the investing side is right now there's almost no spread between cap rates and the 10-year U.S. Treasury. So as an investor, you want to get a return for the risk you're taking on, right? Like, okay, I could buy a treasury bond and get 4% or I could become a landlord and take on a whole bunch of additional risk. So I want to get a lot more than a treasury yield from this property. If the cap rates are low, I'm not going to buy this thing, right? Or I'm going to sell it, right? So you've got that going on. Then, we're starting to see the risk of, I think we see more corporate bankruptcies this year so far than any year in recent record. And so there's a real concern as companies have really stopped hiring that jobs aren't as dependable as they were, and that makes people really skittish, and either influences somebody to sell their house and get the getting while the getting's good. We're also starting to see, we're still early on, but Todd, we are getting into that front end of the bell curve of senior citizens that are now too old to stay in their homes, right? And so you're starting to see increasing forced selling based on that. So there's just a whole bunch of reasons why inventory is coming on. But I think what gives me the greatest confidence that we'll probably overshoot is that's how market corrections work. We see it in all sorts of markets, stocks, et cetera. Housing's no example. When the pendulum starts swinging, you swing from one extreme, you generally swing at another. So you pass through the mean on your way there. And I think that, we're getting close to the historic mean right now. I would be surprised if we just flatline there. I think we continue going while the housing market still continues to soften.
Yeah. And a lot of what you're explaining, and by the way, I agree with everything you're saying.
Yeah. Oh, I'm sorry. I forgot one more important thing. Do you mind if I shove one more other reason, which we've talked about in the past, which is just the dramatic jump in the cost of home ownership, meaning people who are in their home, right? Hey, I've owned this home for a number of years. My plan had been to stay in it for a good while longer, but oh my God, my property taxes jumped up. My insurance skyrocketed. Maintenance around here costs an awful lot. Maybe I'm less confident about my job anymore. So all of a sudden, there's a not insubstantial number, and I think growing number of people who are just saying, I can't afford to keep the house that I have.
Yeah. And all of this is surrounding around the mess that the market, the rate manipulation, the Fed rate, that manipulation and the manipulating of the bond markets and the manipulating of the um, quantitative easing, pushing those mortgage rates down, the government getting involved in pushing those mortgage rates down, all resulted in the price of a home being the farthest away than it ever has from the average or median income of a potential home buyer or a homeowner to maintain that home, which puts them in what I consider a real precarious spot, because in a lot of the ways of you're talking about needing to stimulate growth in the economy and encourage businesses to go out and borrow money for growing their businesses, their operations, their opportunities for jobs, by lowering the rate in order to make that more advantageous for them to take on this debt or to refinance the debt that's coming up for renewal, is in a lot of ways going to push asset prices potentially higher if it worked. And then we're talking about wages needing to not just keep up with inflation, but keep up with those asset prices. Right. And the cost of owning those assets, the home, maintenance, taxes, insurance, getting even farther away. What is your opinion then with all of this? And guys, if you're listening to this and your head's ready to explode, just think about this for a minute of what kind of a position we're really in here, when people can't afford basic housing, whether it's rentals or rental costs or ownership. Well, landlords can't afford to maintain the rentals to keep those costs affordable. So like Adam's saying, that's going to result to turn them into for sale inventory. What is the position here? I mean, if you had to strategize, like, okay, the next move, Trump's pushing to lower Powell to drop rates significantly. We're not talking about 50 basis points.
Yeah, no, he's asking for like a 300 basis point reduction right now. Yeah.
Right. Which would be, so what kind of implications does that have?
Well, so that would just be more of you used the word manipulation earlier of these interest rates, right? Those are the deformations that Stockman was talking about, right? And what's crazy is we habituated the housing market, not just the housing market, but in the case of housing here, we habituated the housing market to a completely unsustainable, distortedly low environment. And we kept it there for so long that everybody got used to it, addicted to it. And now everybody is yearning and demanding a return back to the good old days without an acknowledgement of they were never real. Right? It wasn't based in reality. It was all based in deforming the system. It was a manufactured mirage. And it doesn't mean you couldn't have made a lot of money and your house didn't appreciate and all that stuff and what all happened, but it wasn't based in the fundamentals of economic reality, right? So you really only have one of two choices, which is to let the system, revert to true price levels, which I think we've started to see in the cost of capital, but we haven't seen it yet in the prices in housing, and that's why I'm so convinced that prices are going to come down from here. And it's also you see it in the pressure and the political scope to try to, hey, well, maybe we can get back and put our thumb on the scale again, and man, wouldn't that be nice, right? So your question raises a couple of questions, Todd. One is, well, what's going to happen with financial assets? Are they just going to get goosed from here and get even crazier? Maybe. The market tends to price in what it think is going to happen, and the market has priced in rate cuts for this year and for next year. So if the Fed starts cutting rates, you may actually not see much of a change in asset prices, because the market is already anticipating. Now, if the Fed was to cut really aggressively, like if the Fed was to go from 4 down to 1, um, then yes, they would definitely move. Although in that case, just to be clear, they might actually go down. Asset prices might go down because they're thinking, "Oh my God, if the Fed is cutting that significantly here, they're freaked out about something," and it might actually end up spooking the markets. But in theory, over time, if the Fed engaged in a long term rate cutting and got us back to the 1% era, that would generally be supportive of asset prices. I don't necessarily think we're going to get there, Todd. I think there's a lot of constraints to that happening, as much as Trump would like to see it. And Trump's the kind of guy that puts the anchor way out here and then usually strikes a deal somewhere in the middle. So maybe he'd be just fine with something in the low threes, but he's putting one out there just to get everybody all hot and bothered about it. Who knows, right? But to your larger question, like I said, I think we're in for a rocky next 6 to 9 months. I do think the odds aren't bad that things pick up for a bit after that. But in the long term, what I'm worried about, which I think we're taking this there with your question, is kind of like, where does this all end up, right? If we continue with efforts to goose corporate profits, but also try to manipulate the cost of money so that asset prices, continue to get elevated. And we're investing in technologies that really favor the parties that own the technology and disfavor those who are in competition with it, which in this case is laborers, both blue collar and white collar. That's where we end up in my I-shaped economy that I'm so worried about, which is, I think I can see over the long term that asset prices continue to rise, aggressively. And who does that benefit? That benefits the people that own them, right? And we already know that 93% of all financial assets are owned by the top 10% of households, right? I think that concentration is going to continue, right? So those who own the assets and those who own the means of production, I think will do just great. And they're going to be that little dot up in their little, Elysium by themselves. And it's everybody else who increasingly gets left behind that is going to have vastly diminished prospects unless we take a different tack than we're taking right now. And the AI folks, look, I'm not anti-AI. I think there's a lot of great benefits it'll bring to society. But I think we have to be much more planful than we are right now in how we're executing on it. And when you talk to the big AI fans and you really poke at like, well, what happened? A lot of them say, well, this isn't going to displace jobs. And I'm not convinced of that. I do agree that it will create jobs in the near term in the trades, right, as we build out all this new infrastructure. But as we're already seeing in a growing number of companies, there are software programmers that are recruited to build AI tools. And then once the AI tools are built, they fire the programmers that built them because they don't need them anymore, right? We're going to see that just all over the economy. And so, where I think we end up in a place here where there's just a truckload of people that are displaced. And so the AI folks say, yeah, okay, but then we'll have universal basic income. You know what? We will take some of these corporate profits and we will, fund people's essentials, and you'll be able to stay at home and learn anything you want, and use this time to find your best self. And we just know, Todd, that humans do not do well with that. Both culturally, we've given everybody in the world access to the world's information for free here, and what do? We torment ourselves on social media and we watch cat videos and pornography, right? It does not bring out our highest selves. And just economically, we know, and we've actually seen this during COVID. What happens when you give people free money? Well, they rush out to spend it, and then prices go up as much as you gave new money into the system, right? So you immediately get inflation that negates the benefit of the UBI check that you're giving people. So even economically, it doesn't work convincingly.
Yeah. Well, you talk about AI creating jobs, at least in the trades, to get these data centers built. And I would say, yes, you're right. If you're that company that gets the contracts that are bringing in as many people as you can, but like you said, when the project's done, we're really going to see a collapse of those jobs. No different than the multifamily sector. We're seeing a lot of people. Once these buildings are built out, it takes a couple of years to build a building, and they have as many people there to build it so that they can get it done. They hire, and then if they don't have another big building to go to, well, I mean, this creates the problem. And I relate this to what we see in major city infrastructure like bridges and overpasses and highways. Yes, they create an enormous amount of jobs, but that doesn't benefit the other contractors that don't have those contracts. So, you will see a pickup in employees, the ones that are involved in these projects. But I don't know that is the answer. I think personally that AI is going to be more harmful than good in a lot of ways. I mean, yeah, medically speaking, I mean, there are a lot of benefits if you're a researcher or you're uh, writing copy. It makes your job very easy. You can get rid of all 25 other people doing the same thing in the job because you only need one to get something in 2 seconds that would take you 25 or 30 minutes to write.
Absolutely.
But I want to say, in the housing sector, do you think that we'll start buying mortgage-backed securities again and pushing these mortgage rates down to 2 and 3%?
I hope not. I hope not. I don't know, but the folks who I have talked to who are closer to the halls of power with the central banks than I mean, look, I think in a crisis, anything's possible, right? So, if we get stuck in a deep recession, sure, they'll buy everything under the sun. But the Fed did get a lot of pushback to QE, especially near the end. Didn't stop them from doing it for way too long, but they did. And what I have heard is that that's a tool that's going to be taken out of the toolkit very reluctantly in the future, and will highly likely, like right now with the quantitative tightening process that's going on, they're really trying to get the mortgage-backed securities off the Fed balance sheet. They're really trying to restore it back to just a Treasury type of balance sheet. So there's maybe not a ton, but I think there's an increasing amount of political disdain for the Fed to step in and try to support other asset prices in general. I mean, it's really just to keep the system alive, and that's why it buys treasuries, right? Because treasuries, that's the lifeblood of the U.S. economy, but really the global economy. So I guess that's a long-winded way, Todd, of saying I don't see it happening anytime soon, and probably not until and unless there's a bad enough crisis where it's a kitchen sink response from them.
To where you don't want something to happen on your watch. Not you, Adam Taggart, but the politicians' watch.
The politicians, yeah. And so if you don't mind, let me get one more thing into the AI just before I forget, because it is material, which is, AI is software, and software is, eating the world these days, and it's going to displace an unbelievable amount of people like we're talking about here. And like I said, I think in the short term, there will be trade opportunities for things that software can't do, right? Welding, great example, right? But
there's some robotic welding machines that are pretty
damn good. I think the day is
good.
coming much faster than folks expect when that's going to be done by robots. Yeah, exactly. And I've mentioned this publicly a couple of times recently. I've kind of had this epiphany about Tesla. I was not a super Tesla bro in past years. But what I have come to, it's kind of clicked in my mind of late, is Elon is pursuing creating the smartest AI in the world, right? And the AI race is going to be pretty much a winner-take-all race. Right now we've got, XAI with Grok, and we've got ChatGPT, and we've got Google with Gemini, and Meta with Llama. So there's a number of big players that are trying to compete in this space, and only a massively deep-pocketed player with a ton of tech talent can win this race. You and I there's no way we're going to create our own little AI, in a garage that's going to end up being the best of the world. It's going to be one of these massive players. And so I think Elon's goal is, all right, I'm going to create the best AI in the world. And right now he's got a pretty good argument with Grok 4 that he is in the leading position right now. And so that's going to be the smartest software. Now, I think Tesla is going to be not a car company. It's going to be the company that makes the things that AI controls in the real world, right? So that's self-driving cars. It's now going to be self-driving taxis. Supposedly by the end of this year, they're going to have the public launch of their release of their Optimus robot, right? Their humanoid robots. So it'll increasingly be humanoid robots that are going to do way more things than most people imagine they're going to be able to do. And then after that, it's going to be any kind of machine. Might not look like a person at all. It's going to be highly specialized to some need out there in the world. But I think that's what Tesla is going to be building. It's going to be literally building just the things that AI needs to control in the physical world. And I've been kind of half joking. It's probably going to end in it building all the drones and machines that Skynet uses to kill us, 20 years from now, like in the Terminator. But that future is hurtling towards us. And whether it's Tesla that wins in this, or whether it's a Chinese company or another American company or whatever, who knows? But that's the future we're going to. And this is a poor analogy, but it's worth mentioning. So on my channel last week, Todd, I got on this trend like a microsecond before it started getting picked up all across the major media. But I went to Grok and I asked it to create a song for me. My daughter just started a new job and she has to travel across the country doing event production for this company. And so I said, hey, write me a song about a girl named Merritt, that's my daughter's name, who's driving across the country, driving across America, having a great road trip. And Grok, turns out, can't actually produce the song for you, but it gave me the lyrics, and I then put them in another app, company called Suno, and instantly it generated a song for me. And I mean a song, like vocals, instruments, I mean a whole package song. And
composed the whole thing.
Tell you, Todd, it's not bad. Like, it's not going to win a Grammy, but it's a pretty decent song. Like, if I walked into a bar or restaurant that was playing in the background, I wouldn't bat an eye. I would totally believed it, right? Totally sounds like a real person. Again, not a bad song, very well, decently constructed. The instruments they all sound totally legit. And that's today, right? And AI is growing at an exponential rate here. So already AI is showing us that if you're in the creative business, and I don't necessarily mean like a musician or a copywriter, although those are two things that AI is totally getting rid of right now. But anything creatively, we're seeing all these AI videos that are coming online that are looking better and better. They're not perfect, but they're getting better and better very fast. But PowerPoints, spreadsheets, one of the guys I interview said, yeah, we just hired a chief technology officer to help us just leapfrog ahead in AI stuff. And I took some of my podcasts and said, hey, can we make these into PowerPoints? Because he does a lot of technical analysis. And he said within like seconds, he had this very high-end produced set of charts based on everything that he had just talked about, which is already packaged and ready to be given to a client. So, think of creative very, very broadly, right? That's going to kill a tremendous amount of jobs in the very near future, right? Because even if it's only 80% as good as a human, it's 100% cheaper. And there's a lot of jobs where the employer will trade that off.
Yeah, but most good employees only get you to 80, 90% anyway, and then you put the 20 or 10% to it to get it to the way that you want it, right? I mean, that's the whole idea.
Well, and that's 80% today on something that's getting exponentially smarter. So it might be at 90% in 6 months or a year, right? And
or
that 80
smarter
to
than
90% doesn't go to bed, right? Doesn't take vacations, doesn't have any HR issues, doesn't need health insurance, right? So it is really, like when you really think about it, you're like, this is just a locomotive that is coming at us head on that I can't say I know exactly what the order of magnitude is going to be, but I can make an argument that it's going to be pretty big. And we are just not having the discussions right now. I think I've told you about this before, but Keynes, the famous economist, he warned about this concept called technological displacement, where he said, if technology can do a job better than a human laborer, you should replace the human labor. There's no argument with that. But you have to be careful at the pace at which you replace that human labor. If you replace it faster than you're finding additional productive use of that displaced human labor, you're going to create a social problem that is going to be more costly than the cost savings of the new technology you're adopting. And a lot of people will say, hey, Adam, you know what? Like, we've had technological transitions in the past, right? You know, the cotton gin, the
wheel.
the assembly line, whatever, right? And it's true, but usually in the past, it was sequential, right? Like, so, okay, we disrupted, agriculture with machines like the cotton gin. Okay, so you lost your farm job. Well, now there's this new technology called the assembly line, and you can go over and work for Ford and, get a good day's pay to build cars, right? The problem is we're disrupting pretty much every industry at once right now. So you're going to
Good
be
point.
shedding jobs everywhere, and you're not going to have another place to pull them all into. Yeah, we will need some plumbers and stuff like this in the maybe the next 5 to 10 years build out of all the infrastructure. But to your example of the multifamily unit, once that build out wave is over, yeah, we kind of don't need them anymore. And during that build out wave, those human welders and carpenters and whatever will probably increasingly get replaced with specialized robots to do that stuff.
And they know, by the way, I mean, these construction workers, contractors understand that there is no promise beyond the completion of that project. They know that it's and they can't just take their time because they have the prices were already written as to what the costs are, and the contractor has to perform within that price. So they can't just say, "Well, I'm going to make." There's 3 more months left in this job, but let's all work slow, and we'll finish it in a year and a half. No, it's they know they have to finish that job, and when it's done, they have to find another one. Let's talk about stablecoin.
Okay. I'm not a huge expert on it, but I do have a couple ideas.
When you went, by the way, to the Rick Rule conference, which was you just got back less than 2 weeks ago, right?
Mm-hmm. Yeah.
And now it's Donald Trump signed it, right?
Oh yeah, the Genius Act.
Yeah, right. So that is new since the Rick Rule conference. How does this change everything that we're talking about?
Yeah. So first, I really got to just be transparent. I am not a crypto expert here, so take everything I say here with a grain of salt. So, not surprisingly, there were definitely people at this conference who were, big proponents of Bitcoin. And no huge surprise, right? Amongst a conference where people are very concerned about the loss of purchasing power of fiat currency, you're going to have a lot of crypto people there saying, "Hey, we feel the same way," and a lot of arguments about what's superior. Is it the Bitcoins of the world, or is it the old school ounces of gold? And I'm not here to convince people one way or the other on that. I mean, I've got some general ideas, but I'm no expert, at least on the crypto part, like I said. But I've been wondering, like, why the rush? Like, why are we rushing into this, right? Like, I don't remember stablecoins being a huge part of Trump's platform. I knew he was saying he was, kind of crypto friendly, but it was very vague what that meant, right? Now, there are smarter people than I, like David Sachs, who is the AI czar for Trump. And one of those people who doesn't need to be, very successful guy in his own, is doing this because of his passion for the technology, who says, hey, this is actually needed. This is basically infrastructure. This is kind of the rails of how commerce and the financial system will work in the future, and we need to do this. And all right, I'll take that at face value, even though I don't really have enough knowledge to make a super informed opinion one way or the other. The thing that did stick in my mind, though, is we are having we started this whole conversation where I talked about the higher for longer bond yields that we have right now, right? And how that just acts like gravity on the economy, right? And the Trump administration would like nothing more, and they've been very, very transparent about this. They want that yield down, right? They want the U.S. Treasury at least under 4%. They'd probably love it getting closer down to 3.0%. But they've had a really hard time getting it down there, right? It's kind of been ping-ponging back and forth between like 4.1 and 4.5. And no matter how they try to get it down, it floats back up, right? And there's a number of reasons for that. But one reason is that foreigners are not buying our treasuries the way they used to. Now, some people think that, hey, that means the world's giving up on the dollar and the dollar is going to become toilet paper tomorrow. I really tell people slow your roll on that one. I don't think it's not nearly that cut and dry, but we are seeing the world have a smaller or lower appetite for our debt, and that is a concern if you're running a country. So if you're the Trump administration, you're saying, all right, man, we really want to get these bond yields down. Like, what else can we do? Well, if we let stable coins multiply, they have to back themselves with US treasuries. That's how it's a stable coin. You tie it to the US dollar, and you do that by buying treasuries. So if we approve all these stable coins and give them a big mandate, that's new buyers of US treasuries. And that new buying will raise treasury prices and reduce bond yields. So I see it as all part of the grand game, a continuation to a certain extent, Todd, of David Stockman's defamation of the administration kind of orchestrating additional buying of treasuries to try to keep the U.S. debt costs lower and let the party continue for longer.
It's a way of printing more currency. It's just...
It's sort of, I mean, I guess it is, because the stable coins are a new form of currency. Yeah. And they're using that new demand to support, the fiscal efforts, just the same way that if the Fed was buying our debt, like the Fed is not buying treasuries right now, right? It's in quantitative tightening, right? So this would be a supplanter for the Fed. Now, I think what Trump would love is, at some point, we'd have stable coins buying, and at some point, the Fed would resort to some form of remonetization of the U.S. debt, but that's going to be a while.
Yeah. Well, and this is why, and I'll just say this, Adam, and I've been doing a lot of data mining and sort of looking at where we are and the affordability crisis in the housing sector. That's what I focus on. And of course, everybody looks at me to say, Todd, should I buy a house now? Should I wait? Am I going to miss the boat if I don't buy now? And asset prices. Well, I mean, to anyone listening, the bottom line is you have to be able to afford it. And I think one of the things that we're seeing is that with the rapid home price increase and the affordability falling as a result of jobs not keeping up with that type of inflation, housing inflation, coupled with the rising cost of home ownership, a lot of people didn't know what they could afford or what they would end up needing to afford just a couple of years later. I mean, so they bought it with the understanding that, hey, I can afford this. And then all of a sudden their payment went from $3,600 to $4,300 a month. And they have also, it's their primary residence. So they're taking advantage, and that increase included their homestead tax credits, and they still end up spending $600 or $700 quickly more a month than when they bought the home just 2 years ago.
Yeah.
And meanwhile, their salaries haven't really gone up. So the question becomes, number one, the real issue becomes, number one, if you can't afford to buy a house at these costs, then don't buy it just because you think that maybe the asset prices are going to go up, because between now and then you may go under and end up being financially devastated. However, what I'm coming more and more and drawing to a conclusion, and I know people are going to, they call me out on this, because you either tell people that the housing prices are coming down and you get the people saying you're lying, they're never coming down, or you say the home prices are going to go up, and then you have the other half saying you're lying, they're crashing, you're pivoting, you this, blah, 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 blah. So you can't, like we said in the beginning, you can't make everybody happy. But when I look at things over the history of time, home prices are going up, and they've only really come down one time significantly since World War II, and that was in the 08 crisis.
That was the GFC, yeah.
In 19, they tried to correct, and the Fed stepped in and started buying mortgage-backed securities like they did in 2009. Mm-hmm. So then prices reverted and started climbing again. They suppressed the rates. I think this may be the last dip we see in decades of home prices, and I don't know where they're going to bottom out.
Hmm.
But I believe that with this new stablecoin theory and finding a way to stimulate the economy, AI, all these different things,
Mhm.
we're going to see that these asset prices are going to go higher. The wealthy are going to take advantage of them, or anyone that was able to buy. And maybe for decades, we'll see the worst unaffordability housing crisis, worse than what we've seen in the pandemic boom as a result of manipulation and recurrency.
Yeah. Yeah. I understand where you're going with that. And part of me wants to be like, I'm right there with you, Todd. And I certainly can't discount that. I'm maybe not quite as willing to put that stake in the ground. Um, and a big reason for that is demographics.
But hold
Right.
on.
Yep.
Before you answer that,
Go ahead. Yep.
we have more people convincing us that tiny homes are the great way of life. We have more people living in RVs, campers, buses, cars, homeless, living in tents
Mhm.
than ever before. And we're seeing where they're going to be doing fractional ownership is coming. Look, don't own a piece of a home. I'm talking about traditional home ownership as we know it and as our ancestors have known it.
Right. Yeah. Um, how to tackle this. So let me just get that last thought out. So we do have 20 years of the passing of the baby boomer generation ahead of us, and I do see that as being disinflationary to deflationary in home prices for 2 decades, right? Uh, that's a really a deflationary force. Now, will there be other forces pushing against it that may win out? Possibly, right? To what you're talking about, but that's a big one. So
Who will buy them?
pardon me.
Who will buy them?
Well, exactly.
They're
And
bigger homes that people can't afford.
right.
The higher cost to heat and cool these houses and care for them and maintain them and all the things, not to mention the baby boomers have stopped fixing them up.
Right. So a lot of deferred maintenance. Yeah.
So who will buy them?
Right. So that's why like I'm not maybe as willing as you to say, yeah, we might have a short term price correction in the real estate market, but then it's off to the races for the next 30 years because we're going to have that demographic headwind. So that's one of the things that I think may play in there.
Adam,
Yeah.
these investors, these companies that we're talking about profiting off of this, everything that's going on right now will be so fast. The minute that these prices get into any kind of a range that they feel is,
Yeah.
that they can jump in there and hang on to these assets, man, we've already seen this.
So you're raising a great point here, and this is really interesting, right? And this kind of goes to the, if you're right, then we definitely move to my I-shape economy, right? Where basically all the housing stock is owned by that little dot, right? And we're all just renters, right? We're all just renting, serfs of the wealthy elite. And I can't say that that's not going to happen. I mean, I personally feel that this is so egregious that we have let investor ownership of our single family homes become as high as it is. I can understand for a multifamily or an apartment building or whatever. Yeah, sure, you need to have somebody with deep pockets to do that, right? And the thing that's really like blowing my mind is why do we let foreign landlords buy single family homes here, right? Somebody who's never going to live in this house isn't an American, doesn't even live in this country, right? Why should we let them snap up our dearly valued homes and take them away from aspiring home builders who actually want to create a family and live in that house and work in America and contribute to the American economy? And I think we're just maybe starting to see that pendulum shift, right? So you've seen some of the news where we're now starting to do that with farmland, where recently we've started putting some restrictions on China, and there's some discussion about maybe asking China to actually divest itself from the farmland that it's bought here. Because as I've said for many years, like there's all sorts of, we have precedents for this. Like first we have zoning laws, commercial, residential, like we have, laws in place that can determine when and where a home can be built. But we also have precedent of like, we don't let the Chinese own our ports and stuff like that here in this country because it's strategically important. I would think we would say, look, single family homes for where young families can, basically build America's population of tomorrow. That's strategically important. Like we shouldn't allow foreign nationals in there. And I think the pendulum may eventually swing there. But then the question arises, well, why should we let U.S. institutions be in there as well? And so I don't know. This is one where I could see people arguing both sides of this very effectively. Some saying, yes, we absolutely need to do this, and the pendulum's eventually going to swing, and there's going to be enough blowback of young people who can't afford homes that there'll be legislation passed, and this will become, somewhat of a protected asset. And then I see other people more like it sounds like the argument you're making, which is, oh, no way. Just the elites, the oligarchy, whatever you want to call it, they're just going to use their advantage to, keep the rules written to their benefit, and they're just going to come out and snap all this stuff up. And again, we're going to be, instead of the company store, it's going to be the company nation. Yeah. So I don't know. But again, Todd, if you're right, we just get to my I-shaped economy even faster.
Which is what you said in the first place.
Yeah.
I don't
Todd, it's so fun
right.
talking to you. And to be real clear, folks, I don't want to be selling doom and gloom here. Although there's a lot to be gloomy about as we're talking about.
I think I think it's important to talk. I don't like to call it so much doom and gloom as I say caution.
Yeah.
As we're coming into it, we're at a time of you need to evaluate what's really important to you and your family, your loved ones, and be cautious. And there is a great upside. We still we still live in the United States of America. I mean, I'm convinced this is the best country to be in. I mean, I'm an American. I love being an American. I'm not saying that there isn't opportunities and ways around it, but putting your head in the sand is not the way to be successful. Yeah. It's a way to be complacent and a way to wake up one day and be satisfied with universal basic income. I don't think that you wouldn't want that. I don't want that, right? So we need to be mindful of how we're raising our children, how we're teaching people, how we're mentoring people, how we're educating people, and giving them things to think about other than listening to narratives that are being pushed by people with agendas. I don't have an agenda on what I'm saying right now. If anything, I'm shooting myself in the foot telling
it's a housing guy.
I'm a real estate broker, for crying out loud. I make money when people buy and sell houses. I'm trying to educate people.
Yeah. So, and again, as a kindred spirit for you in that space, I just am hugely appreciative of what you do through all your efforts, this channel and beyond, Todd. And I think a key thing that you're putting your finger on here, which I really try to talk about too, is agency. Right, which is everybody has agency in this story. We just need to step up and grab it, right? And so it's easy to either put your head in the sand, like you're talking about, right? And that strategy generally doesn't serve anybody well. And it's another thing to pay attention and then just get really depressed by the challenges and kind of, capitulate. Well, why should I even try, right? Well, the reality is that that's not a winning strategy either. And we all do individually have agency in the story. There may be some societal trends here that you can't change, but you can be aware of them and say, okay, well, how can I position myself, A, to be less vulnerable to them, and B, maybe to actually even take advantage of them? I think AI is a great example. So for everybody watching this right now who's still in the workforce, my advice to you is get familiar with AI, get comfortable with it, and, answer the question, how can I use this to make me more valuable at the things that I do to get paid? And if you do that and work on it, A, I'm convinced you will find ways to use AI to turbocharge your productivity. And two, if you do, you'll be much less likely to get displaced in this wave. And in fact, your expertise might even increase your market value. Right? That's just one example. But this is not a story of just roll over and give up. It's a story of agency and making sure that you seize what you can.
Excellent point, my friend. And All of your information is in the show notes below. I encourage everybody to check Adam out. He has a newsletter you can subscribe to and a YouTube channel. Follow him on X. Substack is, I think, is that growing pretty well?
Yeah, yeah. I've got to say, it's Thoughtful Money is about a year and a half into its existence since I left my prior company, which did something similar, except I just own and control 100% of Thoughtful Money. So I really couldn't be happier with the growth, and more importantly, just the general feedback that I get from the audience here, Todd. As you know, it's a lot of work, but it really is a privilege to be able to do this for a living, and I take that very seriously. Where my role is to try to educate, just like you, so try to bring in the right experts, and in taking the time to really try to match. Okay, this week, given what's going on in the world, who's the right expert to come in and talk about that, and then make sure that if I do these long discussions like you do, hour plus, make sure I'm actually giving people good value for that hour of their time. I know their time is valuable, and they're doing this to learn. So when they leave, I want to make sure they feel that they've gotten smarter and hopefully empowered by the conversation.
No, well, excellent. Well, I always appreciate your time and look forward to having you back.
Hey, it's always such a pleasure, Todd. Thanks so much for inviting me back on. Again, a huge shout out to your audience. I always get such great feedback from them in the comments, but also usually get a lot of nice emails and stuff like that from folks too. So our audiences are very like-minded. And yeah, I just want to say that they've treated me very well so far. So thank you, everybody.
Excellent.
All right. See you soon, Todd.
Thanks so much for watching. If you liked the video, you can let us know by smashing that thumbs up. And if you haven't already subscribed to our channel, please consider doing so now. Hit that alert bell. You'll know every time we upload content just like this. Keep those comments and questions coming. And one of the biggest compliments you can do for us all here at Sachs Realty is to share our channel and this video with your family and friends. This will help us to continue to build this amazing online community with viewers just like yourself. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.